Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. It ain't easy being a clothing retailer these days. For those of us stuck at home during the pandemic, Stitch Fix was a godsend. The popular fashion subscription service saw revenue growth over 20%, except for 2020. But the most recent quarterly call gave investors a lot to chew on, and shares plunged more than 23% in one day. For us, that places the stock in the buy zone. And while others run away from the fashion company, we see huge potential. And considering it's barely behind meme star GameStop in the top retail searches by financial pros this month, according to our proprietary data, we know folks are interested. So, online personal styling retailer Stitch Fix started in 2011 as a women's apparel subscription service and expanded to men in 2016. The company provides styling services and merchandise from other brands, as well as its own private label, exclusive brands. Stitch Fix uses data science and human judgment to deliver personalized product shipments. Each box is known as a fix and is curated by company stylists in exchange for a styling fee. 5 items are included in each box. This service came with high advertising spend since its launch. Additionally, privacy changes hurt Stitch Fix's ability to target customers. Looking at the financials, we should note that Stitch Fix isn't growing at gangbuster rates of 50 to 100% that we see with some startups. However, they continue to grow their active clients, revenues, and revenues per client steadily. We also want to point out the positive operating and free cash flow every year except for 2021. Moving to valuations, the majority of different metrics don't work given the company has negative earnings. That said, we want to point out the company currently trades at less than 1 times trailing and forward sales. By nearly every standard, that's incredibly cheap. The firm has invested into customer onboarding and experience. We feel the potential payoff in higher revenues per customer and new growth from new products will significantly add to the company's bottom line. In our opinion, this is a 10 out of 10 stock. Shares could trade lower, but not by much. We feel the company is simply too cheap relative to its potential growth. The company engenders strong customer loyalty that creates a stable base from which to grow. All they need is time. Click and subscribe to the Spill newsletter to get the full breakdown.